In this enlightening video, renowned author, investor, and businessman Robert Kiyosaki discusses the impending economic catastrophe and provides valuable insights on how to secure your financial future. Kiyosaki highlights the risks associated with keeping money in banks and suggests alternative investments with higher yields. Here's what you need to know. The global economy is facing unprecedented challenges, comparable to those seen during World War II. Recognizing this, Kiyosaki urges individuals to take measures to survive the economic turmoil. He questions the reliability of banks, particularly considering the Federal Reserve's recent actions. The Federal Reserve has been raising interest rates, which can lead to negative consequences for equities, bonds, real estate, and the U.S. dollar. Kiyosaki argues that these rate hikes could potentially trigger a massive $1 quadrillion crash in the derivatives market. Kiyosaki's views on the Federal Reserve are rooted in his belief that central banks prioritize protecting the banks themselves rather than the general public. He emphasizes that the continuous creation of fake money by central banks, including the Federal Reserve and the FDIC, is a recipe for hyperinflation. Kiyosaki points out the risks associated with bailing out failed banks, as this practice can lead to further inflation and negatively impact taxpayers. The current financial crisis has already resulted in the closure of banks such as Silicon Valley Bank and Signature Bank. This has caused instability in the banking sector, raising concerns about the potential pressure on other banks and the need for regulatory intervention. The effects of these economic dynamics extend to various aspects of personal finance. Here's how they can affect you. 1. Bank savings and CDs. With interest rates on savings accounts and certificates of deposit CDs remaining low, the returns are meager. However, rising interest rates can benefit savers, as banks may raise yields to attract deposits. This could lead to higher profits on savings. 2. Mortgage rates. Increasing interest rates can make mortgages more expensive. As borrowers rush to secure fixed-rate loans before rates rise further, it's wise to lock in mortgage rates at the current level. Lower mortgage rates make purchasing a property more affordable. 3. Debt management. Rising interest rates increase the cost of variable-rate debts, making it more expensive to carry such debts. It's advisable to pay off variable-rate debts before interest rates climb further. 4. Bonds and stocks. Interest rate hikes impact the bond market, causing bond prices to rise and yields to fall. This can affect fixed-income investors negatively. Additionally, rising interest rates can prompt investors to shift their portfolios from stocks to bonds, leading to a potential drop in the stock market. 5. Credit card debt. Credit card interest rates typically follow the federal funds rate set by the Federal Reserve. As interest rates rise, credit card debt becomes more expensive to carry. To protect your wealth from the potential risks associated with the current economic situation, Kiyosaki suggests investing in inflation hedge assets like gold and silver. These precious metals have historically held their value and are considered a means of preserving wealth across generations. Gold, in particular, has shown resilience against the depreciation of paper currencies. Investing in gold and silver can be an effective strategy to counter the effects of inflation. Kiyosaki shares the story of his uncle, who took advantage of the 2008 recession by investing in gold and treasury bonds. The value of his investments increased over time, providing stability and a hedge against financial uncertainties. In summary, Kiyosaki's insights shed light on the risks associated with traditional banking and the potential benefits of alternative investments. By considering these recommendations and diversifying your portfolio with assets like gold and silver, you can protect your financial well-being in challenging economic times.